every single day, people get trapped in either breakout long positions or breakdown short positions. Today's YouTube video will make sure that that never ever happens again. We are going to speak about 3 very important things when it comes down to trading deviations. First thing is, what is a deviation? Number 2 is, why do we even trade deviation? And number 3 will be obviously, how do we trade these deviations? Well, what actually is a deviation? A deviation occurs when the price, after finding a certain range, after creating certain key levels, breaks out above a key level or a range high level, or breaks down below a key level or range low level. So when we look at the chart over here, guys, we can see that I've drawn out a quick little range over here. And let's say the price is ranging, right? When price is ranging inside of a range like this, and by creating the range low pivots and the range high pivots over here, what are we doing? We are not only creating liquidity over here, but we are also creating key levels, right? So we are creating liquidity above the range high and liquidity below the range low. But on the other hand, we are creating a key level of support over here and a key level of resistance over here by tapping into that level multiple times. Now, what often happens is, like I said, we are also engineering liquidity over here and engineering liquidity over here. Now, the issue is, the thing is where people make a mistake, and this is exactly answering question number 2. Why do we trade deviations? The mistake that people make is that once price starts breaking out of the range over here, what is the human reaction to this kind of price behavior? Get into the mind of the retail traders. What will the human reaction be to this kind of price behavior? The human reaction will be to FOMO into a buy or long position. But what do these people not realize? And this is exactly why we trade these kind of deviations. They don't realize that they are buying into a liquidity pool where smart money is potentially looking to unload their long and buy positions that they accumulated at lower levels, or to potentially accumulate short and sell positions. How do they do this? They do this, first of all, because of the unfilled orders that are left right there. Second of all, because of the stop losses that are resting right there, right? Because often above the range high is where a lot of stops of short positions are resting, and below the range low is where a lot of stops of long positions are resting. Now they use them stops to accumulate or distribute their own bigger buy or sell orders. But what they are also doing, and this is where people are making the mistake, they are absorbing the long pressure when people are, for example, breakout longing over here with their stop loss over here or maybe around the mid-range, or when people are breakdown shorting over here when the price breaks down with their stop loss over here or around the mid-range. They can absorb that sell or long pressure in order to fill their own bigger buy and sell orders. Because if people are breakout longing, they can use the people that are breakout longing or buying in order to sell their own bigger orders to them. Because you have to think like a market maker, right? Those orders are so big. If they want to sell millions and millions of orders, on the other hand, there are also millions and millions of orders needed to buy from them in order for them to be able to sell. It's simply supply and demand. When you go to a supermarket and you want to buy a fucking citrus, but there's no supply of citruses right now, how the fuck are you going to buy that citrus, right? So that's the way you have to think. It just makes sense when you try to think in a logical way and not try to make things as hard as possible. And this is exactly why we trade deviations. Why? Because retail traders, they don't understand this. Retail traders think that they should be trading breakouts. Retail traders think that they should be trading breakdowns. But instead, we should trade them the reversed way, because that is exactly what smart money is doing. They're looking for shorts over here and they're looking for longs over here. Why? Because this is where the liquidity is being provided for them in order to fill their own bigger buy or sell orders. And what do we want to do? Is not follow the retail traders. No, instead we want to follow the bigger players inside of this market. And that is exactly why we trade these kind of deviations. Now let's move over to the final topic of this video, which is probably the most important topic, which is how do we trade these deviations? How do we execute these trades and how do we make money instead of losing money? Okay, so let's say we have the range over here and we have liquidity that is being built up around the range high with a mid-range that is getting respected as support or resistance, and then we have liquidity that is being built up around the range low, right? This is a very simple way obviously to draw a range. In practice, obviously it's a little more difficult to spot this kind of range, but that's a topic for another video. Let's say we have this range and we have liquidity at both sides. What you want to do is simply set your alerts around the range low or set your alerts around the range high. The simplest way to trade deviations, and in my Discord community, in my course that I've built, I have about 10 different entry models, but in this video I'm going to explain to you guys one of the entry models, which is the most basic one, and in my opinion not the highest probability one, but it is the simplest way to try and trade a deviation, which means that you are always waiting for price to either break out or break down. And what is going to happen is you are not going to simply buy over here, guys. That's the stupidest thing that you can do. First of all, what's your invalidation gonna be? You're either going to have to use a very wide invalidation if there's a certain low, for example, over here that you can use as your invalidation, right? Or you're gonna have to use a very tight invalidation. Now, both of these kind of things is not something that we would really like to do. What you want to do instead is wait for a perfect retest of that range low. So the price is going to offer a perfect retest. Now, what have I taught you guys? If price is truly bearish after a breakdown, it doesn't offer perfect retest. I've explained this many times. If price is truly bullish after a breakout, it doesn't offer perfect retest of the range high. So we know that if price is going to offer a perfect retest, there's a decent / high probability that we are potentially looking at a potential deviation. Now, after this perfect retest, step number 2 is that you're going to have to wait for a sweep of the first local low. This is exactly why we don't blindly buy over here, stop beneath the local low and target the range high to anticipate a deviation, because often you get a sweep of that local low. Now you might think, but Guru, why does it sweep that local low after this perfect retest? Because after this perfect retest, by sweeping the local low over here, we create a fake break of structure. Get into the minds of the retail traders. What are they seeing? They're seeing a perfect retest of that range low after the breakdown, followed by a fake break of structure to the downside. In their opinion though, this is not a fake break of structure, but this is a true and a valid break of structure to the downside. So what are they going to do? Exactly. They're going to accumulate even more short and sell positions over here. Panic shorting, panic selling, stop above this high, stop above this high, or stop above either one of these highs over here. So what are they doing? They're adding to the sell pressure that smart money can then use to absorb even more long and buy positions, and they are engineering liquidity to the upside by putting their stops above the local highs, and we can then use that liquidity as a drawn liquidity to target for a take profit target. Alright, so we trap even more people after the perfect retest. Now step number 3 is that you want to wait for a reclaim of that range low. This is where the people that accumulated short and sells over here and over here become underwater on their position. Okay, this is where they start freaking out. Now we do not only want a reclaim of that range low, we want a reclaim in confluence with a break of structure over here. You guys know that a break of structure doesn't simply consist out of a wick above that high or a candle close above that high. No, we need a candle open and candle close above this high that brought us to this fresh low compared to this low that brought us to that high. Now, if we reclaim the range low after the local sweep in confluence with the break of structure, you have yourself a long trigger. Once again, realize if price is truly bullish, it quite often doesn't offer these kind of perfect retests before the reversal. Quite often it consolidates, maybe gets a bit of a tiny sweep, and then it reverses back towards the upside. So how do you want to execute these kind of trades? Your first entry needs to be kind of aggressive, stop beneath the local low, target the range high, look at the beautiful RR that we are creating for ourselves, and then the second entry, the DCA order, can either be around the range low, but quite often the first bigger deviation is being followed up by a second smaller deviation, okay, which means that my DCA order is quite often slightly below the range low to anticipate that second smaller deviation over here before the reversal towards the upside. And this is exactly the way, after you have determined the range, after you have determined the key levels and the liquidity, how we want to execute these kind of deviations. Not only are we trading against the majority of the market, which is exactly what we want to do, not only are we creating high RR trades for ourselves, which is exactly what we want to do. But more importantly, we are creating the highest probability trades possible that are out there on the market. I hope you guys enjoyed today's video. More importantly, I hope you guys learned something during today's video. If you guys did enjoy today's video, make sure to smash up the like button, make sure to subscribe to our YouTube channel, and I'll catch you guys on Monday's video. Ciao, ciao!